Good morning, ladies and gentlemen, and welcome to the Montanaro European Smaller Companies Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll. If you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the team from Montanaro. Gordon, George, good morning.
Good morning.
Good morning. So if I can actually start, Gordon Neely, I am a non-executive director of Montanaro. I will take over as the chair in the new year. And first of all, I would say it is a real privilege to be able to present our company to such an esteemed audience. But you will be glad that I'm not going to be the main presentation here. The main man, George Cook, is going to be taking us through the main part of the presentation. However, what I want to do is address some introductory remarks that I think merits coming from the board. The first one is in relation to the board's confidence in the strategy and in the investment process of Montanaro. And then secondly, we want to address what we have tried to do to improve value for shareholders. We spent quite a considerable time over 12 months ago with our shareholders, understanding what they were looking for. And early into 2025, we put in a package of measures which we've tried to stand behind. But these are measures which we viewed the company could stand behind, and it's our intention to make sure that we do stand behind them. First of all, in relation to the strategy and the investment process. As we all know, Montanaro are very long-term in their approach, investing in high-quality growing companies. And I hope, I'm confident, by the end of this presentation, that you will agree that we do what we say on the tin, and that is important, that we are true to our investment philosophy, which we believe has stood the test of time and will stand the test of time. However, in recent periods, there's been significant headwinds, and the board's aware that the performance has been challenging. However, we remain confident the style is distinctive and valid. And within this, the manager's stock selection has been compelling. Within the universe of quality growth companies, stock selection remains positive over the short term and indeed over the long term. And it's been positive when the style has been in favour and also when the style has been out of favour. And the board would attribute the strong stock selection to the fact that Montanaro has the largest, most experienced and stable team focused on European smaller companies. And that's something we don't take lightly at all. The investment process at Montanaro continues to identify profitable, high return businesses that are off the beaten track for most investors. This approach is designed to identify tomorrow's winners at today's prices. The quality of companies in Mescat's portfolio remains as high as ever, and I'm sure that after George has made the presentation, you will also come to that conclusion. Secondly, in relation to the measures we put in place to improve the investment proposition and the attractiveness of the company for shareholders. First of all, we put in place regular tender offers, semi-annual tender offers, with a view to improving liquidity. There has been a lot said about that, but we believe that gives shareholders the chance to either increase their cash return from the investment in a tax-efficient way, or where they make a decision to move part of their shares, they get a chance to do it at close to net asset value. We've also introduced an active share buyback policy with the aim of keeping the discount within single figures. And I'm pleased to say, since we introduced that over 6 months ago, the company has stood true to its policy. And yes, we have bought back quite a number of shares, but our shares have traded at a single discount over the last 6 months, indeed over the last 7 months. The third thing we are very conscious of is the costs involved, and we have taken measures to try and reduce the costs and keep the costs overall within 1%. And that included reducing the management fees for the second time actually in 4 years. Not that we believe that this is all important, but it's important to deliver value for shareholders. And the second aspect of our fees is that they are also changed in market capitalization, which obviously increases the alignment with investors. So I think the board has been quite measured in its response, and we aim to continue to ensure that shareholders see improved liquidity and the opportunity to avoid to have the shares trading at a discount that fairly reflects net asset value. I think that's enough from me at this stage. There will be plenty of opportunity for questions once George has presented, and we're trying to be as open as we can in relation to any questions that shareholders would have. We certainly would encourage you to ask as many questions as possible. But now it's a great pleasure I hand over to George, who will take you through the key presentation.
Well, thank you very much, Gordon, and thank you indeed to everyone for joining us today, for giving us your time. I will skip past the introductory slides and begin with just a very brief introduction to Montanaro. I'll then talk a little bit about why we think European small caps are a good place to be, before quickly diving into the way we invest, the way your trust is managed, and going into some of the detail there, before finishing with a look over the last 5 years, and indeed longer term, to see what have been some of the headwinds and tailwinds to our style in that period. So, Montanaro was founded back in 1991, and we exclusively focus on quoted small and mid caps. Indeed, we have one of the biggest teams just doing that in Europe. It is very much a team approach. 35% of the equity is held by the team. Moreover, more than half the team have been with us for more than a decade. So it is a big and experienced group. We take a quality growth investment style, and I'll come on and explain why we take that approach in just a moment. And we manage around £3 billion. So why should anyone consider European small caps to begin with? Well, they've actually been a very, very good place to be, as this chart hopefully demonstrates. European small caps are shown by the blue line here, and large caps in Europe are shown by the purple line. You can see that not only have small caps delivered very respectable absolute returns, they've also significantly outperformed large caps in what we call the small cap effect. That's despite large caps actually outperforming over the last few years. Moreover, European small caps seem to be particularly good, even in a global context. Here you can see European small caps over on the left-hand side. This is again showing annualized returns back to 2000. You can see that Europe has beaten world small caps, BRICS, China, the Russell 2000, which is of course the US, the NUMIS, which is the UK, emerging markets, and Japan. So despite all the trouble and all the bad headlines that Europe has garnered over the years, European small caps seem to be doing something special. Now, we are only interested in a small subset of small caps. We are quality growth investors. We want to look for the best of the best. And here we try to explain roughly what it is that we're looking for when we talk about quality and growth. We want simple businesses that are predictable through having products and services that are non-discretionary. We want high recurring revenues, high IP, and good pricing power. We want the companies to demonstrate high returns on capital employed, for which, of course, they will need to be profitable at a minimum. They should have strong balance sheets. They should be highly cash generative. We want them to be growing structurally and with control of their own destiny. And we want them to be run by exceptional management teams. We also would like to buy these at sensible valuations. And we find that the best way to get that is to find so-called hidden gems, companies which are not well covered by the sell side and which are overlooked by the wider investment community. Indeed, it's the hidden gems that we think make small caps in Europe so exciting, and they're why we have that big team, so that we can unearth them. Now, the reason we take a quality growth approach is exemplified quite well here. This was a study done by AQR over in the States, and they looked at large and small caps of high and low quality. They went all the way back to 1989, and this is global, and they found that in large caps, it pays to be in high quality over the long term. Large high quality companies are the purple line, large low quality companies are the red line. What they also found is that in small caps, that effect is even bigger. So small high quality companies are the blue line and small low quality companies are the grey line. So our investment approach is to focus solely on companies that live in the blue line, even though companies in the grey line will go through short, sharp periods of significant outperformance. As long-term investors, we think you want to be in the blue line exclusively. When we apply that then and look at our investment process, you can see that it is broken into two stages. In the first stage, our large team of sector experts look for new ideas using a range of screens and tools that we have available to them. When they think they found something really good, then they move to due diligence. This involves filling out a number of checklists. They will be talking to management and indeed other experts from the industry, analysing the growth of the company and the sector that it works in. Many companies fall away during this stage, and it can take 5 or 6 weeks on average to get through this due diligence. But those companies that make it through then go to the investment committee. The investment committee at this stage decide whether it is a high quality and structurally growing business. If it is not, it will simply be rejected. If it is, then it can proceed to the second stage, which is where we conduct our valuation work to ascertain, is this good business also likely to be a good investment? We're also looking at risk here, not only in terms of sort of scenario analyses and downside risk, but also looking at correlations of a stock to the existing portfolio and ascertaining what factor tilts it might have and how they might affect the portfolio were it to be added. After all that, it can be added to our approved list, on which there are about 250 companies. And it is from that approved list that we pick stocks for inclusion in your portfolio. When we have done that, it gives us something like this. This is the top 20 holdings of the European Smaller Companies Trust. Now, I hope that not everyone has heard of every name here, because we are trying to find a few hidden gems. But I think one of the things I want to get across is just how varied the companies, the products and services that they sell are here. We've got everything from aeroplane engine components and maintenance, through to printed circuit board supply, through to independent wealth manager, a cell counting company. We've got a company that does imaging within hospitals for things like X-rays and MRI scans. It's a very varied mix of different products and services being sold to different people, but the common feature is that they are all high quality and with structural growth characteristics. Now, I'd like to dive into a couple of these in a little bit more detail here. So Kitron is currently the largest company in the portfolio in terms of the weighting within the portfolio, that is. And they are an electronic manufacturing services business listed in Norway. But as with many of our companies, actually they have factories around the world. Electronic manufacturing services companies are gaining share because they are benefiting from a couple of major themes. So there is an outsourcing theme where companies, for example, producing larger electronic items, may not feel that they are expert in producing the printed circuit board assembly for that. And so they use specialists like Kitron to do that. There's also a wider growth driver here in the electronification theme. And we see that throughout different end markets, things like medical and defense systems, but also EV charging, for example. What you can see at the bottom here is that the track record of this company is very, very good. So over the last decade or so, they have grown their earnings substantially, and that is down to a stable and very competent management team who have really built this business to be one of the market leaders in the world. Another business, our second largest holding, is Atos. Atos is a very different company. They make workforce management software. Indeed, they are the market leader within the DACH region of Europe. Workforce management software is increasingly critical for any business. The ability to look at attendance management and workforce scheduling gives you a competitive advantage. The ability to forecast that gives you a further competitive advantage. And of course, there are legal reasons why you would want to have this software too. You can get into a big web of complex laws and difficulties if you aren't paying attention to what the current law says about who can work and how long and when. The company has extremely good EBIT margins in the mid-30s, and again, just like Kitron, despite being quite a different business, has a very good earnings per share track record, no doubt in large part thanks to the founder who remains in charge of the business and the largest shareholder. Those two examples are not alone, and this is a display that we put into the annual report. So it is as of the end of March, and it shows a number of our companies have achieved what we term multi-bagger status. That is, companies that have increased in value by multiple times their original purchase price. Fort Knox, I'm afraid, is no longer with the portfolio. It has been now taken out, but you can see it was far from being alone. Indeed, we've managed to get lots of multi-baggers over the years, thanks to that rigorous focus on quality and long-term growth companies, and of course, our long-term holding approach, giving the companies time to compound. As Gordon mentioned, we are trying to back tomorrow's champions today. We do not change our style and we do not change the way we go about things. We are high-quality growth investors, and from this table you can see that across the years, the companies have demonstrated good revenue and earnings growth, very strong margins and returns, and very strong balance sheets. If we cast our eyes to the bottom of the page, we can also see that portfolio turnover is very low. It's not nothing. We will make mistakes, and indeed we will find new ideas that we think are attractive. But it remains very low, and at 8% in 2024, if anything, it has been coming down. We are long-term investors. Now I start to move toward talking about some of the performance elements now. And I think the first thing to highlight here is the PE of the trust. You can see that for quite a few years leading up to COVID, it was sort of range bound almost in that 20 to 25 times bracket. And then post-COVID, there was a flight by investors into our style, into the type of quality and growth companies that we invest in. And that pushed ratings up across the board. Indeed, our portfolio went up to over 40 times by August 2021. 2022 put paid to that. Rapidly rising interest rates and simply mean reversion caused that to come back down. And we now sit at a much more perhaps sensible level in the low 20s. But when we come and talk about performance, of course, we need to bear in mind where the starting point for this chart is. One thing we do believe is that it is worth paying up for those companies that deliver on earnings. And to try and demonstrate this, we've pulled together this table. What we've done is we've gone all the way back to 2006 and looked at what people expected earnings per share growth to be versus what actually happened. On the left-hand side, you can see what the case was for our trust. So consensus expected on average those companies to grow at 14.5%. And I'm afraid they didn't quite manage that, but they did manage nearly 12.5%. So pretty good. Over on the right-hand side of the page, we can see that consensus expected the average small cap in Europe to grow at 13.3%, but actually they grew by less than 5%. So when we're buying quality and when we're talking about quality, one of the features we like is that they have recurring revenues and an ability to grow even when the macro environment might not be so favourable. Now, looking at the last 5 years, it has been a difficult time from a relative perspective for the trust, and there are 3 key reasons for this. The first is small cap underperforming large cap, the second is growth underperforming value, and the third is the underperformance of quality as a style. And I hopefully will come on and explain these in more detail and give clarity to these in the following slides. Looking at small caps versus large caps, we saw earlier that small caps have outperformed their larger counterparts significantly over a very long time. And indeed, this chart shows the same thing. This is European small caps versus large caps within Europe. Up and to the right means that small caps over the long term have outperformed, as we already saw. But you can also see to the right-hand side of this chart that small caps have gone through an almost historic drawdown versus large caps over the last few years. Perhaps just coming toward an end over on the very recent past. But it has been a very difficult time to be a small cap investor compared to large. What's been driving that, in large part, has been PE ratios. So this chart shows you small cap PEs versus the market. For most of my career, I have talked about the need to pay a premium to own small caps versus the market. And indeed, on average, small caps have traded around about a 15% premium to the wider market, only dipping down below that and into negative territory in times of total crisis, such as the GFC, when they were at a 4% discount. More recently, though, we've seen a significant relative derating of small caps, and now we sit more than 2 standard deviations below that long-term average and at, frankly, crisis levels in terms of relative PE. We are at a 7% discount of small caps to the market. We believe this presents an opportunity for longer-term investors. Now, within small cap, we are exposed, of course, to 2 major style influences, quality and growth. From a growth perspective, here we show small cap growth versus value over time. You can see that in the 5 years leading up to September 2020, growth had a very, very good period, particularly at the end when quality and growth came into favor. In the 5 years since, it has been very, very difficult because value has outperformed by some 54%. Over the 10 years, of course, it's made very little difference at all. But we do need to bear in mind these headwinds and tailwinds when we're looking at performance numbers. Here is a similar thing, but from a quality perspective. So this shows European quality versus the market. We look at 1-year rolling returns here. And we can see when this chart is going up, that is quality outperforming. And when the chart goes down, quality is underperforming. We, of course, have seen over the long term, going back to that AQR chart, what quality is capable of. But, of course, in the shorter term, things can be more volatile. In that post-COVID period, quality was very much in favor, and we moved up to a peak in around September 2020. Since then, 2022, and more recently in the last few months, we've seen pullbacks in quality relative to the market. It has done relatively poorly. And you can see that really this is quite extreme on a historical basis. You really have to go back a long way to find the last time quality had done as badly as it has more recently. Now, forgive the detailed table here, but what we want to do is try and quantify how big those effects are on our portfolio, and are we adding value from a stock selection within the style. To do that, we've picked out 3 time periods. In the left column, we've got September 15 to September 20. In the middle column, we have September 20 to September 25. And then on the right-hand side, we have the whole 10-year period from 2015 to 2025. If you cast your eye to where the red arrow is, this shows the factor effects, which are mostly style through that period. So in that first period, 2015 to 2020, there was a significant tailwind to performance from factor, predominantly from style. In the second 5-year period, from 20 to 25, there was a very significant headwind from factors, again, predominantly driven by style, as we've just seen quality and growth was underperforming. Over the whole period 2015 to 25, there's actually been a bit of a style headwind, but factors as a whole have been marginally positive thanks to sector selection predominantly. If we go down to the bottom, we can see what the stock picking element has done within that style, and we see a much more stable picture. So in 15 to 20, when style was in favour, stock picking was positive. In 2020 to 2025, when style was very much out of favour, stock picking has remained positive. And indeed, when we then take that over the 10-year period, we can see that stock picking has been the predominant driver of relative performance over that time. This gives us some confidence that our process is working and continues to work, even though we will sit through style headwinds and tailwinds, given we want to remain quality growth investors long term. That has been reflected in the longer term performance. The blue line here is the NAV of Meskit on a total return net of fees basis, and the purple line is the benchmark. Gordon referenced the discount earlier, of course, and thanks to the board measures, that has been brought in versus the last couple of years and now sits at a single-digit level. And from a gearing perspective, the blue bars here show the level of gearing. You can see that we raised it earlier on in the year. It now sits around 6%, which is to say that we find lots of good opportunities in the stocks that we're investing in, hence we have some gearing. To summarise then, we believe there are a number of reasons why the trust remains attractive. The long-term track record remains very good. The discount is at 8%, but that compares to even a premium a few years ago. From a timing perspective, while this is of course more of an art than a science, small caps have rarely been as cheap versus large caps as they are now. And of course, we are also looking at a period where quality and growth, our style components, have done particularly poorly of late. The company remains high quality, and we believe it's attractively valued, certainly versus the peak levels from just a few years ago. And it continues to grow with good earnings growth over many, many years. That concludes the formal part of the presentation and leaves us with hopefully plenty of time to answer questions. Thank you.
Perfect, guys. If I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Gordon, George, as you can see there, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. But guys, at this point, if I may just hand back to you to read out those questions and give your responses where it's appropriate to do so. And if I pick up from you at the end, that'd be great. Thank you.
Thank you. Sorry, allow me a sip of water. Right, a question from Paul. Are you considering lowering your fees? Gordon, I will pass that to you.
Okay, this one is reasonably straightforward to deal with. We did lower our fees in March of this year with effect from 1st of April of this year. We had a reasonably significant change in the fees, and that has been the second time in the last 4 years that we've done that. So we now believe our fees to be competitive, but equally important, we recognise that one of the things that we do have here is that we've got the largest, most experienced and stable team. The work they do to identify tomorrow's winners is significant. So we are conscious of that fact, and we would rather have the resource dedicated to finding the best investments than simply get it a little bit cheaper. But I think you will find our fees are comparable as they sit now.
Great. Next question is, the differentiation between the growth and quality factors has been stark. Have George and the team been leaning more towards growth companies? And is this the reason why stock selection has been so strong? No, we haven't been leaning more towards growth companies. We always want to invest in companies that possess both factors, so both quality and growth. We haven't been leaning more to one or the other because we're sort of always quite overweight both factors, if you like. Indeed, growth companies versus value, they've been particularly poor over the last 5 years. So had we just dove into growth and ignored quality, it wouldn't have helped us all that much. The right place to be in that period within small caps has been really in value. The reason why stock selection has been so strong, no, stock selection is really independent of those factors, because stock selection is calculated after considering the head or tailwinds that you've had from things like quality, growth, and indeed other factors. So stock selection should be relatively independent of those, and hopefully is a reflection of our investment process doing its thing. I have another question. Your fact sheet shows 28% of holdings in the UK, yet none were shown on your top 20 list. Can you explain, please? I think that must be a confusion in which fact sheet is being looked at there. To be very clear, the European Smaller Companies Trust is continental European smaller companies only. We don't own any UK companies within this trust. We have other products where we have pan-European products. It may be that you're looking at the wrong fact sheet there. The next question, looking at slide 14, why has average EPS growth for the MSCI Europe ex UK small cap underperformed expectations so much? Is this mainly due to larger holdings in the index not delivering as expected? Good question. I think there's a couple of things going on here. I think at the start of each year, consensus tend to be quite optimistic. And then as the year goes on, reality sets in, and usually the reality is not quite as rosy as consensus will put in their financial models. That, of course, if we're going through a period, this period from 2006 to 2024 will include periods of outright crisis and recession globally and within Europe. So I think particularly in those years where there is a very difficult macroeconomic backdrop, that's when also discretionary items will be pulled back. But it's also when companies like the types of companies we invest in that have less discretionary items for sale, which have higher recurring revenues, for example, they will tend to hold up better in those environments. So that's why I think you have that dispersion. Thomas has asked, what is the reason quality underperformed, and what is the likelihood of the quality style being broken over the long term? And if it's not, why don't you think so? Again, great questions. What is the reason that quality underperformed? I think if we go back to the underperformance in 2022, it was relatively clear. The reason it underperformed in 2022 is that it outperformed very significantly in the year or two prior. Investors have got very excited by quality and growth in that sort of slightly strange environment post-COVID, and had bid them up to very high valuations. So 2022 was really a normalization of that, and probably due given what sort of PEs had done. The more recent one is far tougher to explain, quite frankly, and far tougher to find a really good reason for it. We have seen certain sectors, which I suppose would not be considered to be particularly quality, have done very well. I mean, things like small cap banks. There are many small cap banks which have gone up hundreds of % over the recent years, having of course gone down much more significantly in the years prior to that. And we're not going to be particularly interested in those companies, but they will have moments in the sun. I think similarly, you might find things like gold mining, small caps. Again, we're not particularly interested in those from a long-term perspective, but they will have moments, particularly when gold does well, where the miners might follow. So I think those are the key reasons. But it's much harder to explain the more recent drawdown in quality than previous ones, which I suppose is hopefully really reason to be more optimistic as well. What is the likelihood of the quality style being broken over the long term? Well, I think quite unlikely. Of course, the very long-term track record that we showed with the AQR slides just here is pretty compelling. But even just from almost a pure mathematical perspective, for you to gain in value consistently and for a very long period of time as a company, you need to have a return on capital that is higher than your cost of capital, and you need to be able to deploy capital at those higher rates. If you can't do that, it's mathematically very difficult for you to fundamentally become much more valuable. So I don't believe it's broken as a style. It would, that would require almost a complete rewriting of financial mathematics. What do you see as the biggest risks to investing in European small caps at the moment? I suppose always the biggest risk of investing in small caps is a deep recession or depression that comes through. Of course, there are always kind of macro and political issues in Europe, but frankly, if you let those put you off, you would never have been invested for the last couple of decades, and they've made good returns in that period. It's hard for me to answer that specific question, quite frankly, despite being a European small cap manager, because we're so focused on just a small subset of those companies, and the risks that might apply to an oil and gas explorer or a gold miner or a bank, they simply don't apply in the same way to our portfolio. So we're very bottom-up focused. We're very much focused on the risks for our specific companies, which don't necessarily translate particularly well to the broader index. On a separate note, has the liquidity of small caps deteriorated in recent years? I appreciate the investment trust structure helps with this, just interested in general comments. It's not my impression that it has particularly deteriorated. I wouldn't say it's moved noticeably, particularly one way or the other. We have very strict liquidity requirements before we start looking at an idea, but there are so many companies within the universe that it certainly doesn't restrict us. So no, I wouldn't say it's been a massive effect there. And yes, you're quite right, the investment trust structure does help with that, although we do remain sort of the view that you need to be very careful of liquidity as a small cap manager. Are we seeing M&A? Yes, indeed. The last year or two, we've seen more M&A than we did for quite a few years before that, which I think is a sign that we're not the only people spotting value down in this area of the market. So just to give a couple of examples there, we talked about Fort Knox during the presentation. That was a company, a cloud accounting software business in Sweden. That was taken out by private equity and management. Another example was a company called Esca, a similar deal. They were a French software business focused on automating invoices and things like that for companies. They were taken out too. So yeah, we are seeing a bit of a pickup. It's not at sort of absolute peak levels. If you went to sort of 2006-07, I'm sure there would have been even more, but it's been a pickup, a noticeable pickup from previously very low levels. Can you talk about your approach to gearing, structure, cost? What might make you change your gearing levels? Yes. So we have two gearing facilities within the trust. So one is a fixed drawdown, and one is one that we can. It's an RCF that we can draw down if we want to. I think the broad view there is that a normal environment, we should have a little bit of gearing. It's one of the great advantages of the investment trust structure. And of course, our asset class has shown very good long-term returns. So being a bit geared seems to be a good default. We won't tend to go to net cash, but we'll take gearing down to nothing when we're feeling sort of bearish. Our main approach, quite frankly, is rather than trying to predict macro, which I find to be very, very difficult, to the point of being frankly impossible to do reliably and better than the market, we simply look at what are the opportunities in the portfolio. Are we sort of sat thinking, gosh, there's so many really good ideas here that are really cheap and screaming buys? If that's the case, it's usually a good idea to have gearing quite high. If on the other hand, like at the end of 2021, we're sat thinking, oh, this is a bit more difficult, you know, valuations are up with events and are pricing in a lot, then that's when we would tend to bring gearing down. So rather than trying to be clever from a macro perspective, it's very much bottom-up driven.
Well, it's just one comment I would add to that, and that is we have to remember our promise to shareholders, which is we aim to keep the shares at a single figure discount. And when the style headwinds have been against us, we have been buying back quite a number of shares. So that factors very much within the thinking. We don't make the promise lightly. We make the promise after real consideration and discussion with our shareholders. So that will always factor in our thinking in relation both to the level of gearing and also the nature of the gearing.
Okay, the next question. Why do you not combine with the Montanaro UK Smaller Companies Trust and run a pan-European trust, as both trusts are very small in comparison to competitors? Well, I can give an answer to that, but I'm sure Gordon may also want to address that as well. Would you like to start, Gordon?
No, I'll let you go from the investment side. Sure.
But I think firstly, just say I'm not sure that in the UK there's huge demand for a pan-European product, but that's by the by. From an investment side, of course, I'm just focused on making sure that I'm the manager of the European Trust, not the UK Trust. I'm focused on making sure that the European Trust is the best it can be. What I would say in relation to size, you're right, it is small versus the competitors. That isn't a plain disadvantage. It has pros and cons, but you know, one of the great pros of that is that we can be very nimble. We can invest lower down the market cap spectrum and with more conviction than we would be able to if we were, say, managing $1 billion in this product. So small is beautiful in some senses, and I don't particularly see it as a disadvantage. From an investment perspective, frankly, almost the opposite.
I think the only thing I would add to that is I agree entirely with it. The discussions that we have had with investors is that pan-European generally is viewed as less attractive, and we don't see much benefit in being in a universe of really one. So I think that is important. So we see enough opportunity within our own remit without the need to extend that into the UK. And I think it's a different proposition altogether.
Does the European Trust now invest in the defence sector, bearing in mind the importance of that sector now? We have ethical restrictions in the Trust and always have done. And those ethical restrictions do prevent us from, in simple terms, investing in sort of guns and ammo, so to speak. But of course, you do get peripheral defence exposure. For example, MTU aero engines, while they're predominantly focused on commercial aircraft engines, they do have components that go into, for example, the Eurofighter platform. So you will not see us in Rheinmetall or the like. And of course, that's been, it's been not a good decision, if you like, over the last year or two. They've done very well, and we haven't been invested in them. But we do. It's not that we have zero exposure to that as a wider theme. Another example there would be a company called Invisio. They do communication systems, which do have predominantly defense-related applications, but have less of the ethical issues that might come with a bomb maker. What do you think, in your opinion, is a fair absolute level of the PE ratio of your portfolio? You stated that the range was from 40 to 20 PE. Are we at a fair absolute level now? Can you elaborate on your thinking? What did you think when the portfolio traded at 40? Yes, I could go on about this for hours. I'll try not to. I believe that where we are at the minute is a fair PE. If we look at what the PE we're at now, it's pretty similar to the PE we were at 10 years ago. And of course, we've made very good absolute and relative returns over that period. So we don't rely on a re-rating to make good returns or to outperform from this point, in my view. So on that basis, I think they're fair. I mean, funnily enough, that 40 times, yes, we certainly, when it was at 40 times, when we got to the end of 2021, we brought the gearing down to reference my previous point, because we weren't seeing quite so many really good opportunities. Of course, PE, valuation as a whole, you need quite a long-term horizon for it to start to matter. I mean, PEs can do almost anything in a short term over the next year. They make a big difference over 1 year. As you stretch your time horizon much further, it tends to be earnings growth, in my view, that drives things more than your starting PE. The reason I raise that is that I suspect if we go 10 years down the line, we will find that 40 times PE may not have been overvalued, in fact, and may have just been a reasonable reflection. But that's just my opinion. Of course, when we're doing our valuation work, we're not predominantly looking at just at PE, and we are taking things on a stock-by-stock basis. It's quite hard to make sweeping statements in the aggregate, I find. You have shown in the presentation that European small caps are historically cheap and currently trading at a discount to large cap. What does a similar analysis show for your investable universe of small cap quality growth versus large cap quality growth? Good question. I'm afraid this is where we start to struggle, because, and if anyone is from MSCI is listening to this, please make a small cap quality growth benchmark, because it would make our life a lot easier. That they don't exist, so therefore it's very hard for us to see what the PE of those are. We can create them synthetically. I think it's broadly fair to say, though, that quality growth within large and small caps has suffered very deeply in the last few months, and really since that peak in 2021. I'm not sure there would be a wild difference in how much they have suffered. I'm sorry, I just don't have the data to be able to answer that in more detail. Sorry, I'm just working my way through the questions here. Why is the European Trust performing so much better than the UK Trust? I assume both funds have access to the same process and the same team of analysts. They do. Sorry, I'm going to sort of pass through that question. Yeah, I'm not involved. I'm not the manager for the UK Trust. I just focused on making sure that this trust does as well as it possibly can. You are one of the smallest European trusts and have some activist investors on your share register. Are you worried that you will not be allowed the time to demonstrate that your quality growth strategy will eventually deliver superior outperformance? Gordon, you may wish to comment on that one.
Yeah, I mean, I think it's a very valid question. I think the short answer to that is no, we're not worried, because our job is to deliver value for our shareholders. And if our shareholders determine they don't want us, that we're no longer relevant, or they don't believe in the story, then we've got to look at a different proposition. However, in talking to our investors, there's a large body of shareholders, including some, as you would call, activist investors, who are very supportive of our approach and very patient in the way we look at it. I don't think we have many short-term activist investors within our portfolio today, within our share register today. We have seen over the past 6 months, we've bought back well over 30 million shares. And so we've actually addressed a lot of that activity. And I think we've got a bunch of shareholders now who believe in us and continue to support us. Hopefully, once the performance starts to come through, we'll see others starting to come on the register. But it's a very, very valid and fair question. But it's certainly not something that would worry us.
Right. Is the process a toe hold and increase? and a one in, one out approach, so keeping to around 50 holdings, which probably distinguishes to some bigger peers that have more holdings. So it generally is a toe-hold and increase process. The only exception to that would be if we've had a company that's been on our approved list for many years, so we know it really, really well and have followed it very closely for many years, then we might take a slightly bigger position, although we would still seek to build it. So yeah, broadly speaking, a new company you know less well than one that you've been covering for a decade. And so generally speaking, we would buy an initial position and then build it over time. It's not quite a one in, one out approach. What we say is that we want to own around 50 holdings, but that range can be sort of 45 to 55. The reason we do that is that I prefer that approach myself, because if I find a company that I really want to buy, I think, oh gosh, this is a compelling opportunity, I'd like to just be able to buy it. It may be that something to sell isn't quite as compelling at that moment in time. So I'd rather just buy it, not have to be forced to go and sell something right at that moment. But of course, in due course, then if there does become a more compelling sell target, then we can sell it at the most optimal time. So what you find over the long term is that we move around the sort of 50 number, but that it's not a precise and totally ruthless kind of one in, one out approach for that reason. Just allows us a bit more flexibility on timing the entries and exits. You're quite right in terms of that 50 holdings. Yeah, you're right, and I know some of our larger peers do have many more holdings. Some of them have a triple-digit number of holdings. That is not the approach that we think would be optimal for the trust, and so yeah, you should expect 50 to be about the right number going forward too. And again, that's one of the great advantages of being slightly smaller, is you can have a more concentrated portfolio of higher conviction ideas. Could you please talk a bit about your sell discipline? Also, in terms of risk management, are there specific holding or sector weight limits in place? Yep. So our sell discipline, we will sell a company essentially if we start to see the quality or long-term growth outlook deteriorating. We will sell it. That is the investment case deteriorating in our view. So we will exit the position. We'll also, of course, exit if a stock becomes too big, if it becomes, if it's taken over, so on and so forth. Those are relatively easy. In terms of risk management, yes, we will not own more than 7.5% in any individual position. We believe that target weight would be a maximum of about 4%. And so having that hard limit of 7.5 means that we can let those winners run without letting our risks kind of get out of control. We're well aware that we can and we will make mistakes, and we don't want one mistake to be the end of the portfolio. And yes, there are various sector limits in place. There's also, from a much more granular perspective, we look at many different factors, and we look at things like the volatility of individual positions and so on as well. So we are, before we hit most of those outright limits, our risk management system would be flagging up issues like that sort of ahead of that. So it's very, very rare that we get anywhere close to the hard limits in practice. Are you having to sell shares to provide cash to fund buybacks? And if so, does this mean you are having to sell down holdings you would prefer not to, given any liquidity issues in the market? So yes, we do have to sell shares to provide cash to fund the buybacks to some extent, because it's the only way to do it. But in terms of selling down holdings we'd prefer not to, given liquidity issues, no, we're very, very careful before we even start looking at a company, let alone before it's moving into the portfolio. We do extensive liquidity analyses, and we make sure that the portfolio and the individual names within it are liquid enough. Ultimately, just from an investment perspective, we would never want to get trapped into a position. If we felt it was deteriorating, we'd never want to be in a position where we couldn't exit it without sort of crushing the price. So we just avoid the most illiquid names to begin with, which of course means there's less impact when we do need to sell here. Looking ahead, what would be the ideal market conditions for relative performance to improve, in particular for the style headwind to turn into a tailwind? Very good question. I think historically, quality growth companies have particularly done relatively well in times where the sort of macro economy is not doing so well, where there might be more of a sort of cyclical downturn. That's when people suddenly realize, gosh, I don't really want to own this company that's highly levered and has an extremely cyclical revenue profile. So they sell them and fly to quality. So if we think about the environments where the last major environment like that I can remember would be when the Eurozone crisis, when people were really panicking about that, quality and growth did very, very well. The post-COVID period was slightly odd because it was frankly less kind of to do with the macro and more just sort of more really investor flow as much as anything else. It was less easy to explain. I guess collapsing interest rates would have helped it too. So I think if you have very rapidly falling interest rates, it tends to be a tailwind for those styles. Very rapidly increasing interest rates tends to be a headwind. But I have to say, through it all, of course, it's very natural for us all to be talking about these style swings because they've been so extreme over the last sort of 6 or 7 years. It's not really normal for them to be that extreme. And so I hope that actually the next period we won't see quite such major swings. We don't particularly like them because, of course, it might be nice when they're working for you, but then inevitably they start working against you. So my hope is that actually we don't see massive swings either way, and maybe we just see a more gradual tailwind from quality growth, because as we've seen from the AQR chart, it has historically provided that sort of long-term tailwind. I hope that's reasonably answered that question. I've reached the end of the list. I'm just going to quickly see if there's any more in there. Sorry, are you happy with where the NAV currently sits? Gordon, would you like to address that one?
An interesting question. I mean, naturally, we prefer the NAV to be higher and delivering stronger returns for shareholders, but we actually fully understand the reason why it is where it is. And to be clear, we would not be asking Montanaro to change their approach to do something which is alien to them. We think the portfolio is extremely well positioned for long-term growth, and we're confident that the fundamentals, the holdings within the portfolio will create significant value over time. So there is no change in our approach. Yes, we would like NAV to be higher, but we're confident we'll see value accretion in future.
Thank you. There's one question left, which I'll ask, but if you have any final questions, this is probably your last chance to throw them in, so please do if you do. What's the board's long-term vision for the trust, and how do you plan to navigate market challenges? Again, Gordon, would you like to address that one?
Again, our approach is very clear. We're trying to offer something different for investors that you're not necessarily going to find elsewhere. Our approach is to find tomorrow's winners at today's prices. And the Montanaro team is dedicated to researching and finding that companies are capable of sustaining double-digit earnings growth with high returns on investment. That is no straightforward process, but we believe the depth, the experience of the team and the historic track record gives us confidence that that can be delivered. Ultimately, our goal remains clear. We want to deliver the best risk-adjusted returns for our investors and delivering something that will grow capital in real terms. We have done that over the period since Montanaro took over, with 1.9% per annum after costs beating the benchmark and a return of over 10% per annum. So significantly, we believe strongly on where we are, and we aim to continue delivering that value to investors. And important for a lot of investors who are new to this market, if I look at where I want to be tomorrow, I want to be making sure I'm backing tomorrow's companies, tomorrow's winners. That is what's going to provide a better future for me, and we believe we're well positioned in that respect.
Thank you, Gordon. I believe that concludes. I hope we've answered all of the questions there. I believe we have. And so thank you. And I will pass back to Jake now, I believe.
Perfect, George, Gordon, that's great. And thank you very much indeed for being so generous with your time then, addressing all of those questions that came in from investors. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended. But Gordon, perhaps before really now just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and to the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
I think the first thing I would like to say is we've been honoured to have such a significant audience. The amount of time you've devoted to us, the amount of engagement we've had has been really encouraging. We want to continue to hear from investors. We don't have a monopoly in good ideas, and we're always willing to listen and to be challenged. But we believe that we are on the right path. Without question, we've had some significant headwinds, but there will come a point in time where the strong track record that we've delivered over many years will come to the fore, and there'll be significant value accretion for investors. We remain absolutely convinced in this and 100% supportive of what Montanaro are doing and the approach.
That's great. Gordon, George, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the Montanaro European Smaller Companies Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.
Thank you.